Hey everybody, it's Greg Harrelson here with Century 21, the Harrelson Group, with my co-host Abe Safa, also with Century 21, the Harrelson Group. And here we are with another episode of the Myrtle Beach Real Estate TV, and we're going to talk about a little bit about mortgage rates. It's taken its toll on the market for sure, and then also discuss a little bit about how builders and new construction, new developments are responding to the weakening demand. But before we get started, Abe. Hey, welcome. Thanks for joining me, and I'm excited to give them some additional information, man.
Yeah, Greg, always fun to have these conversations.
Yeah, well, let's just dive right in. I think our audience is pretty familiar with us at this point and kind of the information, the type of information. But I think we're going to kick it off and talk a little bit about mortgage rates. So, tell us where we are right now with mortgage rates. What are we seeing out there in the
I mean
marketplace?
that's the big talk right now is mortgage rates, and we're over 7%. I
Yes.
looked up this morning. They vary because it depends on obviously your credit score. It depends on what state you're in. So I saw rates anywhere from 7.3 to as high as 7.87 is what I saw in some places. So I mean that's the story right now. Is rates are just have gone through the roof relative to what they were just a year ago. Right,
Yes.
that's the big story. Now, here's what's interesting, Greg. I actually went back and did some research.
Okay.
I went back because obviously this is all stemming from inflation, right? The whole point of the Federal Reserve raising the Fed rate was because they're trying to slow down inflation. So I went back, and the last time inflation was this high was in 1981. So 1981, inflation was somewhere around 10%, maybe 10.5%. Okay. Do you know what the mortgage rate was back then?
No idea.
18%.
So I don't know, Abe, but now my dad, I guess it wasn't in 81 because I was only 11 years old at that time, but my dad sold real estate when it was 18%. It wasn't then, so there was another time it must have been 18%. But anyways,
Yes, I mean, so relative to inflation, 7% is not that bad, right? In the whole scheme of things. I think the biggest shock is just going from 2.9 to 6 overnight is, I think, what really, really shocked the system, really shocked the market. It's not so
yeah,
much that, 5% is that high. Historically speaking, 5% wasn't that much. Even when it went to 5% now, the market really didn't slow down that much. It was only until we got to 6 and so is when we really started feeling it.
yeah.
And then getting into 7, we're really feeling. And if it breaks 8, which a lot of people are predicting it's going to break 8, I think we're really going to be choked at that point,
Yeah.
as far as the system goes.
Yeah, I am concerned about that. There's no doubt about it, and I wish I wasn't. And the audience knows that we're fairly transparent. That we don't like to make predictions, and if we do kind of give opinions, we like to state it's our opinion versus this is facts. But in my opinion, I am concerned. I actually do think it's going to hit 8. Hopefully, it doesn't take. We don't have to stay there a long time. Hopefully that whatever their feds are looking for when it comes to signs of inflation decreasing, hopefully we'll see those signs and we'll start to creep back down. Again, we just don't know, but I do feel like we're going to see a little bit worse than what we're seeing right now. There's no doubt about it. And the key is what's really interesting about this market, because I've been through downturns before. I was through the downturn of the last recession when it started turning down at the end of 2006, beginning of 07, and then 08 was the recession. And what was happening then, Abe, as you know, was the demand was going down, but supply was going up. And that was a reasoning that we had prices going down, right? Because the two curves were broadening. Demand was low, supply was high. Right now we have demand is low, supply is low. So we're not seeing much of a decrease in pricing. We're just seeing a decrease in the number of transactions. And that does impact the economy, because the economy itself, they want to have somewhere in the 5.5 million sales per year for a healthy economy. Usually if we have 6.5 million, that's like that economy's kind of problematic. It's what we're seeing right now is inflation. And then when we're under 5 million, that's kind of problematic because a real estate transaction employs over 30 people. You got to think about it. A real estate agent gets paid, a mortgage person gets paid, a home inspector, a repair person, a title abstractor, an attorney. The list goes on and on. So every transaction that's not done is 30 to 35 people that are out of work at least in terms of that one transaction. So there's just a lot going on here that it's a whole line of dominoes that that are falling right now.
No question. There's a lot of pieces involved in a real estate
Yes.
transaction. And I'm glad you mentioned 2008 because a lot of people are saying, well, it's going to be 2008 all over again. And I just don't see that, Greg. There's a big difference in today's market than in 2008. 37% of people out there own their home free and clear right now. 38% own their home outright. Okay. 60% of the country refinanced at 4% or below. Right. So there's a lot of equity. There's tons of equity in homes right now. So people have a lot of equity. They're not strapped as far as debt wise. Banks are in a much better position. Inventory is not growing like it was growing in late 2007. Like it went through the roof. We got up to a 23-month supply of homes on the market during that time. We're sitting at 2.3-month supply of inventory right now. So yes, the market is softer. There's less buyers out there. Less buyers. Buyers are more reluctant to buy something. But it's a completely different market than we saw in 2008. There's no comparison between the two.
Yeah. And I don't want to get too far ahead. And, this is probably an area where you and I differ a little bit. I think that we are going to see a decline in prices. And maybe you think some level, and maybe where we differ is I think it could be significant. And a lot of this has to do with okay, like the whole thing about the 37% people have cash, and then the other, 60% people at 4% or somewhere in that range. Those statistics that you gave. See, the key is like I hear that explanation as if people don't have to do anything; they can just hold tight. That's extremely problematic for the economy, because if they're holding tight, that means that money is not cycling through the system, and that can lead to massive unemployment. So there's and then what does that do to prices? I don't really know, because this is unprecedented times. There's plenty of evidence of here's what happens when supply goes up and demand goes down. But when demand goes down and supply goes down, there's not a lot of historical evidence or history that we can actually rely on to tell us what's going to happen.
Yeah, no, absolutely. Yeah. And I just for the record, prices are already going down. So I do believe that prices are going down and will continue to go down. I think something has to happen with the inventory level to see a big drop. Unless we just
yeah.
And
So
the one thing that we don't know, Greg, is yes, there's less buyers out there right now, but it could be temporary. I think the amount of buyers out there is directly related to the interest rate. I think when we get into 6 months from now, if we start seeing a really soft economy and the Fed starts to reduce Fed rate again and mortgage rates go down, and this is a gut feeling, right? I don't have data to provide to prove this, but I think a lot of those buyers could be back in this market in a heartbeat.
Yeah. And a lot of sellers, a lot of the buyers that have left the market are actually sellers, right? They want to sell, but they don't want to have to sell, then buy at a higher interest rate, right? So it's yes, a lower interest rate could bring both the buyer and seller. So it could turn around fast.
Yeah.
It surely could.
2/3 of sellers out there turn out to be buyers as well. I mean, the people have to have a place to live, so they're going to sell and then buy. But yeah, so that's the part with me that I don't think it's going to go down too much because of that one variable. It's not going to take much to reel these buyers back into the market. But I mean, again, we don't know for a fact. Nobody knows that for sure, right?
Another characteristic, and it's the last thing I'll say about it, we can move on, but another characteristic about that 2008 is that did trigger a massive number of foreclosures and short sales. Right. And with your statistics on the interest rates where people have refinanced to, and a lot of equity and a lot of cash owners out there, it's not as likely that we would see massive foreclosures and short sales hit the market. And that really triggered a downward spiral on prices very fast. So it could be much more controlled and much more subtle. I'm just a little bit more concerned of the lack of transactions for the economy right now. But I think we both agree we shouldn't see a bunch of foreclosures. We'll see some, but maybe not a ton.
As a matter of fact, I've got a chart here for foreclosures. Yeah, let me show that to you real quick. I'm glad you brought that up.
Yes.
That's not the one. Give me 1 second. Let me find the right chart. Because yeah, it's the foreclosures. Yes, it was a big spike over the last couple of years, but it's tiny. It's minimal compared to what we saw back then.
Yes. So for the most part, I think, and we'll let Abe pull that up. I will report this about the market right now. Listings come on the market, and if they're priced correct at market value, not lower priced, if it's a residential property and it's priced correctly at market value, we're still getting buyers in the door the first week and making those sales within the first couple of weeks. That is still happening. So for residential sales, the market is really strong. The condo sales, I will say that it seems to be that like we have to price it correctly, but right now there is more competition in some buildings, so we have to price it correctly. Could mean pricing it a little bit more aggressively and getting all of the attention and the offers and then holding firm on your sales price in the negotiation. So that's kind of like the winning strategy, is that price it correctly and then hold firm. Like, so don't build in a lot of room for negotiations. That tends to be the winners when it comes to the people that are putting their property on the market and getting it sold quickly. Just a little tidbit. So what do you have here?
Yeah, absolutely. So this is the foreclosure starts, right? And you can see, like, going back to, this has it by quarter. If you go back and look at what you see where the peak is back in 2008, fourth quarter, 2008, third quarter, then 2009, first and second quarter. I mean, those are huge numbers. And look at where we are now, all the way to the right. This is a little bit old, but the number hasn't changed much.
We're so far away from that.
So it's not even close. Like we're nowhere near seeing like a big foreclosure market coming.
Yeah.
Something major has to happen with the economy in order to see that.
And I will say, Abe, and because I've been talking to a lot of agents and we've been kind of brainstorming about working with buyers. What's interesting, and it's kind of frustrating a lot of real estate agents right now, there are a lot of buyers that actually think we are going to go back to that kind of foreclosure level.
Oh yeah.
I don't know. I don't know if that's a wishful thinking. I don't know what data they could be looking at to formulate that opinion. But we see absolutely zero data that supports that thought. And that's another reason why some buyers are kind of holding back and not making a move. So we have two categories of buyers right now. We have buyers that have been looking for the last year. They are pretty much looking, but not really doing anything because they have regrets. They keep saying, I wish I would have done it last year. I should have done it last year. And now they're kind of holding off. That's one category. Those are the buyers that I would say they were buyers, but that demand is lessening because they're just disinterested at this interest rate and price point. And again, it's not because they have logic. It's because they're playing the I missed out game. Then you have the new category of buyers. These are the buyers that we're me and Abe, or we're marketing, we're advertising. We get a buyer lead today. That buyer already knows the interest rates. They already know the condition of the market. They kind of already know about inflation and the economy. So that buyer, those are the good buyers. So the new buyers that are entering on the market, they're entering based on this is normal and they've accepted it. So let's go look at property. And then where we're really seeing a decrease in the demand are the ones that missed the boat 6 months, a year ago, and they're having a hard time dealing with the new market. I think that they'll come back in at some point, especially if interest rates were decreased. We just don't know when that'll be.
Yeah, and then people looking to buy investments. I mean, it's a different ballgame. Their ROI is completely changed at 7.5%, 8% relative to what it was at 3%. So a lot of those people are also just kind of sitting back and waiting to see what happens with the market. Well, but there's not a whole lot of change. I'm waiting for the first of the month till we see the most updated numbers in our market stat report. So next week we'll pull up those numbers and show if there was any change in pricing. I know the last 2 months, single family homes, the median sales price has held at 350. So I'm curious to see what that goes down to by the end of October. I think it's going to go down maybe 345 range, somewhere in that ballpark is what I'm estimating. But we'll see that next week in next week's report.
I will say, if you are looking to purchase a property, okay, I got a text the other day, and it was an inventory list and discounts from a developer. So this is new construction community, and the developer had inventory that if the buyer would move now, in other words, close this year, they were going to reduce the price $75,000. So a $400,000 property, they're offering it for $325,000 to close it immediately. So what they're doing, by the way, is, for those of you that don't kind of know their strategy, they do not want that inventory on their books because they have to pay interest for it. They have to maintain the house. There's all kinds of, the electricity has to be on. There's all kinds of things that they have to do. They want that out of their portfolio, and they are willing. They like literally publish that to a group of us as agents, $75,000 off. Now, if I was a seller in that community, or if I just bought like 6 months ago, and now all of a sudden that they're discounted it for $75,000, that's kind of painful because that could actually impact the future appraisals. So it's an interesting market.
But if you're a buyer, there could be some opportunities out there with new construction. And another thing, Greg, I'm glad you brought that up because this is where like having the right agent makes a big difference.
Yes.
There's been times we're working with buyers and we're able to negotiate even better with new construction, or for resales, if we're representing the buyer, we've gotten some sellers to buy down the interest rate 1 or 2 points.
Yeah.
So there's a lot of options out there for you as a buyer. You don't have to be stuck with a 7.2% interest rate. We can get some sellers, if we're representing you on the buyer side, to buy down that interest rate down to 6% or 5% for you, in lieu of getting maybe a reduction in price or something like that. So there's a lot of different options out there for you.
So here's exactly what, in this scenario, let me tell you what happened, Abe. Two of the buyer's agents in the office, we've had a meeting about this with people that are working with buyers. We had a meeting about this, and two of the agents in this scenario with the developer, they ended up, I can't remember how much it was, but they ended up buying down the rate from like 7.25 all the way down to 4.75.
Wow. That's huge.
And here's what they did. Now, it was a massive amount of money. I wish I knew the exact dollar amount. It was a big number to get the interest rate down, right? And here's what they did, though. They calculated it like this. They looked at, okay, hypothetically, if that was going to cost $30,000 to buy the rate down, what they looked at is they said, okay, and we've negotiated with the builder. They'll give us $70,000 off. Well, we'll take 30 of that in an interest rate buy down and 40 of it in a reduction of a price. So then what they looked at is they said, okay, it'll cost us $30,000 to buy down the rate. So at the 4.75 rate, at a price $40,000 less, the mortgage let's just say it would have saved them $1,200 per month. Well, they figured that in 3 years, they had already got all their money back. 2.5 years. Mm-hmm. They had already saved in mortgage payments that $30,000. And if they live there for another 8-9 years and they're saving $1,200 a month for the next 8 or 9 years, instead of actually taking that $30,000 and having them reduce their price, it was more beneficial financially for them to buy down the rate. And there's a way to calculate that. So I'll reiterate something you said a minute ago. Mm-hmm. It's important to have a knowledgeable real estate agent working for you. Because believe me, the builder, the agent on site, the buyer, none of them thought of this. It was one of our agents that came up with this, looked at it logically, and saved this buyer thousands of dollars, thousands and thousands of dollars.
Yeah, over the life of that mortgage, the savings are huge. Yeah,
huge.
Look, you can get creative. There's a lot of ways to get things done.
Yeah, that's right. That's right. That's a good point.
All right, so yeah, that's pretty much it. Yeah, so next week we'll look at some numbers heavily because that's when the new numbers will come out at the end of the month, and then that's about it.
Okay, everybody, if you need anything, Abe and I are always available. Our contact information will probably show up in just a minute. There it is right there. Reach out to us. Let us know how we can help you. If you want us to actually touch on any particular points in another episode, tell us that too. We would love to get your recommendations. We'll touch on it and bring that information to you. Bye, everybody.
Thank you for watching.